Good afternoon. Thanks very much for joining. This is Michelle Savage with XBRL US, and you're here for our webinar, DQC Rule Set 16 and SEC FASB Support for the Rules. This program is supported by the efforts of the Center for Data Quality, which is comprised of the organizations that you see on the screen here: Topan Merrill, DataTrax, the AICPA, P3 Data Systems, Altova, Donnelly Financial Solutions, or DFIN, Certant and Insight Software Company, RDG Filings, Broadridge, and Workiva. For our program today, let me walk you through what we're planning on covering. We're going to tell you a little bit about the XBRL US Center for Data Quality and the Data Quality Committee. That's going to be led by Shelley Waveren. Shelley is the new incoming chair for the Data Quality Committee. Shelley is also senior financial consultant at Topan Merrill. Shelley's discussion is going to be followed by a review of the proposed Rule Set 16 by Campbell Pride, our president and CEO here at XBRL US. We're then going to have a couple of CPE questions. So for those of you who are getting CPE credit, please make sure that you respond to the poll questions that you see on your screen. That will then be followed by a review of the final Rule Set 15 by Campbell Pride again, and then we'll have some final CPE questions. We also then want to tell you a little bit about some upcoming events and programs that we think may be of interest. As we go through the program today, if you have any kind of technical difficulties or questions or issues rather, please send us an email at support@xbrl.us. That's support@xbrl.us. And as we go through the program, you can submit questions by clicking on the Q&A link that you'll see on the desktop console. And just key your questions in there, and we'll make sure we get to those as we go through. So with that, I'm going to move on to our next slide, and I'm going to turn it over to Shelley Waveren, our new incoming chair of the DQC.
Thank you, Michelle. The XBRL US Center for Data Quality is a collaboration of public companies, service providers, and data users. Our mission is to address the public's concerns about the quality and usability of XBRL financial data filed with the SEC. Let's go to the next slide. The focus of the DQC is to identify issues that impact data quality and impair the ability to consume and analyze XBRL data. Based on input from the users, we develop guidance and rules that can be accessed free of charge by all users. We are committed to issuing rule sets 3 times a year. This year, we released Rule Set 15 in April. Those rules have been approved and will become effective on September 1st. In addition, Rule Set 16 was released for public comments on July 15th. We will discuss this rule set later in this webinar. And it is expected that on or around November 15th, another rule set will be released for public comments. Throughout the year, we also provide input to the SEC staff and the FASB regarding issues identified in our work. Next slide, please. This slide identifies the names of the members of the XBRL US Data Quality Committee. As you can see, it includes data and tool providers, analysts, preparers, and the standard setters. In addition to this group, there is a data quality working group that meets twice a month. This working group would propose topics for consideration and develop the DQC guidance and validation rules. Those participants are listed on slide 6. Michelle, can you show slide 6? Now let's go to the next slide. Today, I also want to talk about the incorporation of the DQC rules into the US GAAP taxonomy and our relationship with the SEC. Let's take a look at the next slide. Starting in the year 2020, the US GAAP taxonomy includes XBRL US DQC rules taxonomy, or DQCRT. There were 3 DQC rules in the 2020 DQCRT. This year, in 2021, 3 more DQC rules are added to the DQCRT and included in the 2021 US GAAP taxonomy. The inclusion of the DQCRT in the US GAAP taxonomy is to improve exposure to and compliance with the DQC rules. Next slide, please. The rules that are approved by the FASB acceptance program are included in the DQCRT. As you can see on the screen, there's a total of 6 DQC rules that are included in the 2021 DQCRT. DQC 1, axes with inappropriate members, DQC 8, reverse calculation, and DQC 15, negative values. These 3 rules were the original rules included in the 2020 DQCRT. Now, DQC 4, element values are equal. DQC 9, element A must be less than or equal to element B. And DQC 48, required calculation parent element in the cash flow statement. These 3 rules were added to the DQCRT in 2021. It is expected that more and more DQC rules will be included in the future releases of the taxonomy. And I also want to mention that the SEC EDGAR system has incorporated the 2021 DQCRT. So the SEC filing will actually produce warnings for violations to the DQC rules. This shows you that the DQC rules are supported by the SEC. Next slide, please. Filers are strongly encouraged to use the DQC rules before their SEC submissions. This slide, you can see a listing of the DQC certified software, and on the XBRL US website, there is also a free of charge validation tool that can be accessed by all users. That's all I have for this part of the presentation. I'm going to hand this back to Michelle for some CPE questions.
Shelley, thanks very much. Yes, we're actually going to cover 2 CPE questions now, and then we're going to cover 2 CPE questions at the very end. So I think my agenda was a little bit off, but let's go to our first poll question. And I'm going to go ahead and open up the poll here. Okay, so hopefully you should be able to see this. And the first question is, how many times does the Data Quality Committee typically hold public reviews for new rule sets in a year? Is it 3 times, 2 times, or as needed? So if you are getting CPE credit, please make sure that you click on the appropriate button, and so that you can respond to the poll. Okay, we'll take just another 20 seconds or so. Okay, and the correct answer to this one, and I'm going to close down the poll in a second here, is 3 times. So I'm going to go to the second poll question now. Which of the following DQC rules have been incorporated into the US GAAP Taxonomy Release 2021 and are used by the SEC to flag specific errors in company filings? Is it element values are equal, missing components of equity access, or incorrect line item reference? Which is the correct answer to that question? So we'll take just another 30 seconds or so here. Okay, I'm going to shut down the poll now. And the correct answer to that question is element values are equal. Thanks very much for your responses. And now I'm going to turn it over to Campbell Pride, President and CEO of XBRL US, who's going to take us through DQC Rule Set 16. Campbell?
Thank you, Michelle. So we're going to go through the proposed rules. These rules are about to go through for DQC 16 are out for public review. If you want to take these rules and run them against a historical filing that you may have had, or even a filing you're going to do, you can do those from our website, so you can get an idea of what these proposed rules are. And if they apply to you, then it might give you an error that you may not have been aware of. As I mentioned, these are in public review, so there are likely to be some false positives. One of the things we do try to do is to eliminate any false positives in rules. So we don't want you to have to go through and look at rules and say, oh, this isn't correct in my case. So if you do see situations like that, please let us know. We want to try and get these rules as accurate as possible so no one wastes any time following up on things which have been done correctly. So, as we all know, financial reporting can get complicated in some situations. So if you have one of those circumstances which may be a bit strange, we want to know about it, and then we can make sure that the rules take those things into account. So with DQC 16, we'll go through each of these rules. Some of these rules are really trying to address some of the outstanding issues in the financial statements. And some of you may be aware, if you do run validation software on your filings, about things like calculation inconsistencies. And a lot of times, a lot of errors come up that show calculation inconsistencies, which just really aren't valid. And there's a number of reasons for that. They don't take into account dimensions. They don't take into account the fact that you may be reporting open balances or closing balances. So those rules are not particularly, those calculation inconsistency checks in many cases are not useful because they give you more false positives than necessary. So one of the issues that arises from that, we still see a number of incomplete calculations or elements represented in strange ways in the FASB financials, and the rules in DQC 16 are trying to address that. So that's kind of the main thrust of these rules, and that's what they're trying to do. So they may look quite involved, but really what they're trying to do is just make sure that your balance sheet adds up or your cash flow adds up correctly, your income statement. So this first rule is basically, it only works in those cases where you've dimensionalized either your balance sheet, your income statement, your cash flow, or potentially comprehensive income statement. So this rule will run on those four, and then it will look at any values that you've reported using a dimension, and then it will check that if you've reported the sum of those, that breakdown, that those values actually match. This rule works on the basis that if you're using dimensions on the balance sheet, the income statement, or the cash flow, any of the data that you provide is going to add across to a complete total. You're not going to just randomly put numbers in the balance sheet or the income statement. Those numbers mean something, and they're expected to add to some kind of total at the bottom of that statement. So that's the rationale for this. So it checks that those dimensions add across, and it tries to get rid of situations where we see partial dimensions being reported on the balance sheet. So we've run this rule over lots of filings, but you'll probably see as you go through, in some cases, if you do get an error for this, we've tried to make the message on this is quite long, and it tries to explain in a lot of detail why you're getting that error so that you can resolve it. The other thing that this rule does, it's been limited only to certain axes where we've seen that there's been problems, and those are listed here in the rule. And these are the types of things that you typically see in the financial statements. So in some cases, you are going to have values that don't add across the dimensions, and there's valid reasons for that. So those axes have been excluded, and that includes things like the legal entity axes. So this rule applies to very specific situations where you've got to face financial statements, where you've dimensionalized it, and it's going to make sure the default value adds across. So that's what it's trying to do. So if you see an error for that, keep that in mind. We're hoping that it'll solve some of the problems we've seen with dimensional bleed through and double counting of dimensions and default values in financial filings. All right, so if we go to the next slide, please, Michelle. The next rule, this is basically doing a calculation check on the same FASB financials. It kind of works hand in hand with the previous rule. And what this rule tries to do is to basically make sure that any calculations that you've defined in the face financial statements actually make sense. And so this rule will basically only operate on the current reporting period. So it just really looks at the facts that you have in the current reporting period, no others. So that prevents calculation inconsistencies being flagged when you only have partial periods reported or whatever it may be. The other thing it does is only works on those tables where dimensions are used. And what it does is it'll say, I've got a value and it's got a calculated total provided, and it'll go and add those components of it, add them up and make sure they calculate to the total. And if that value has a dimension, if some of the components are dimensionalized, it'll get those dimensional values, or add those up, then add them up into the total. So it's really just making sure that your dimensional breakdowns make sense in the overall face of the financial statement. So a good example might be goodwill, let's say property, plant and equipment, and you break that down dimensionally into different types of property, plant and equipment. Basically, the rule will add all those PP&E items up, get a total, and then make sure that when that PPE is added in the total of assets, that actually adds to a total that makes sense. So that's how we operate on the balance sheet, the income statement, and the cash flow statement. So this rule and the prior rule is really aimed at trying to make sure that the calculations are defined correctly, and the numbers that are being reported in the financials are being entered correctly, and that if you're using dimensions on the face financials, that you're using those dimensions correctly. So we don't expect a large number of errors from these, but there are going to be a few. When we ran on some of the filings, over about 2,000 filings, we saw about 200 errors. So there's like 10% of companies have issues with this. So you probably don't be surprised if you don't see anything. But if you do have an issue, then talk to your filing agent to help you resolve it. You can certainly call us and we can walk you through what the issue is. These are public reviews. So if they're issued, there may be something incorrect in our rule. That is also a possibility. And obviously, as part of the public review, we want to eliminate that. Go to the next slide, please, Michelle. Okay, income before tax equity method. This rule has really been added to make it clearer. For many data analysts have complained about this in terms of they want to get a number before income tax, and there's a lot of and we got feedback that there's a lot of inconsistency in the way that this is done, and one of the issues was the income loss from continuing operations before income tax as a minority interest, and income was being used when companies had no equity method investments. So the point of this rule is to try and clean up the use of the elements there. It's a low impact rule, but it's just really a matter of just tidying up so that if you're running it, you get this error, then you can fix it. So generally, the rule is checking that if you don't have any equity method investments, then don't use the element for income loss before minority interest in equity method investments. Then there's another element you should use for that, and that way we'll get consistency. The other thing it checks is if you report the element before equity method investments, a number of companies have included equity method investments within that total. So that's another flag that you shouldn't be using that element. So it just really helps with element selection and make sure you get the right element when you're running this rule. It also means it makes it easier for folks if they want to get total income before tax. If they want to calculate tax rates, they can do that more easily with the data. Okay, if we go to the next slide. Incorrect line item references. So this rule specifically relates to finance and operating leases, and it relates specifically to the disclosures in the footnotes and those items that are on the balance sheet. So in the footnotes, if the value that you're reporting for the finance lease, for example, the finance lease non-current liability or the current liability or the right of use asset, in many cases, those numbers are going to be buried within another line item. Maybe it's the current liabilities or the long-term liabilities, or either non-current assets, or they may be embedded in PP&E, wherever it is. And the FASB just requires that you report where those amounts are being reported, which line item they're going into. So if you use these, and it uses these elements that you can see here, these extensible list elements. So if you use one of these elements to indicate where your, let's say your current, the right of use asset, the finance lease right of use asset, you use this to indicate that it's included in PP&E net, let's say. What this rule will do is then it will go and look at the face financials of the balance sheet, and will make sure that that line item that you've referenced actually exists in the face of the financial statements. These extensible lists are supposed to be populated with a value which is the same as the element name. So that's what's expected. So the rule will look at that and it'll say, okay, they've said this amount is included in this line, in this caption on the balance sheet. Then it'll go and see if that caption actually exists on the balance sheet. A number of cases, companies have used the wrong element in the extensible list to indicate, or they've used a generic one that they don't have in the face of the financials. So this basically will pick that up. So this rule, this rule doesn't work in all cases. In a large number of cases, folks, a number of companies are not actually, they have that disclosure in their face financials, but they're not picking it up, and so they're not reporting it. So we have another rule, which we'll talk about in a minute, which addresses that as well. This is just checking that where you say the balances in the face of the balance sheet is actually exists on the balance sheet. Go to the next slide, please. This rule is looking at transition elements, and what this means is there are a number of ASUs that have been issued over the years. ASU, and they're listed here, and you can see this in the rules. There's 2016 and 01 and 18. These relate to things like financial instruments and restricted cash and leases. And so as part of these accounting updates, a number of elements in the taxonomy weren't deprecated, but they were called transition elements. And what this means is that the elements was replaced by a new ASU. So if you have adopted the new accounting standard, then you should no longer use these items that are called transition elements. And there's a list, they're listed in the US GAAP taxonomy, so you can see them. But what's happened is a lot of companies have used these elements over the years. But now that the ASU's changed, those elements have been replaced by new elements, but companies haven't gone back and updated for the new elements. So we see a lot of errors there. It's easy to miss. You wouldn't know. It's not like the element's been deprecated. So this rule was just to really flag those situations. So we're working on this rule's there, and it's in public review. We're probably going to update this rule. We've already got some comments to update this rule to tell you, if you've used an incorrect element, then what is the element? Give a list of suggested elements that you should use instead. Some have commented that would be quite useful. But this rule basically goes through and does that. Now, this rule doesn't apply to everyone. For the second set of ASUs, you can see there for ASU 2016-02, 2017-12, and 2018-07, that generally applies to all companies except for emerging growth companies. So this rule, in some cases, depending on the status of your company, won't apply. So if you've used one of these transition elements and you're not getting an error, but you're an emerging growth company, that's the reason. So there are some exceptions to the rule. Okay, can we go to the next slide, please, Michelle? Okay, components of equity on the balance sheet. This kind of relates to this cleanup of the face financials. And we noticed in a number of cases, not many, but in some cases, companies were using the components of equity on the balance sheet, or they were using the partner capital account components axes on the balance sheet. And they're using this axes to try and represent the breakdown of equity. However, there are equivalent line items to do that. And in some cases, this axis was getting confused with the components of the class of stock axes. So they were using this axis instead of the class of stock axes. So this rule basically flag if you used either of these axes, the statement equity components axes or the partner capital components axes on the balance sheet, to either use the class of stock axes or use the line items that are included in the taxonomy. What happens, and you can see this in the SEC rendering, is that when this is done, what happens is you get a lot of what they call bleed through, is you'll get a lot of items that are in the statement of stockholders' equity start to come through on the balance sheet and show up on the balance sheet. And so if you try to calculate totals for the balance sheet, you can't do that anymore because you've got all this stuff flowing through from the statement of equity. So this rule basically just tries to address that. It's kind of rare, but it just makes it really hard for people to be able to use the data when people do this. So this rule has been added in there. So it should be pretty easy to resolve. But in many cases, it's really appropriate to change it with the class of stock axes. But you should look at the case, not automatically do that, and see what's going on. And we've given quite a lot of detail around the rule. Some of these, the rule messages have been quite a bit longer than traditional rules, just to try and explain what's going on, so you have all the details required to resolve it, if need be. Okay, so we go to the next rule, please, Michelle. Okay, so this one, this rule is intended to help basically identify where folks have used the stockholders' equity. Basically, what happens in this case is we've got the stockholders' equity statement, and in some cases, we have companies should be reporting the class of stock, but are using the class of stock axes to break up the class of stock, but are not, and instead they're just using the class of stock axes as a surrogate for the components of equity axes. So what's happening is they'll say, oh, I've got my components of equity, and one of the items on that components of equity is the common stock member. But rather than using the common stock member, they don't use that. They don't use an equity components axes member on the facts related to common stock at all. They'll use the class of stock axes only. So these facts only have one dimension on them in the equity components in the statement of equity, when they should really have two. They should both have the class of stock axes and the components of equity axes. So this rule basically will highlight those cases, and it's just a convenience. It looks like folks have just forgot to put that equity components axes on these facts, so that creates a lot of confusion, and in many cases then the values in the statement of shareholders' equity end up rolling through onto the balance sheet. So this rule addresses that, and if you look at filings that have these errors, you'll see they show up in the SEC rendering as well, or the SEC rendering doesn't look right. So this should help you get this correct, and it's an easy mistake to make, so hopefully this is going to address that relatively easily. Okay, the next rule, if you go to the next one, please. Okay, this is the one the rule I referred to earlier. So this rule applies to a 10Ks and 20Fs, where the filer has lease liabilities and assets, but has not included those lease liabilities, assets in the presentation of the link base. So basically what this rule is looking for is to say you've got these, you've got a lease liability, and you've got a lease liability current, but you haven't indicated in which, and you haven't reported anything on the balance sheet, but you haven't indicated into which line item these items are being used on the balance sheet. So it's just really, you've got the disclosure, but you're not telling anyone in which component of the balance sheet it's going. So, so if it doesn't appear, So what this guidance do is just bring that to everyone's attention so that you know how to fix it. And this is kind of important, particularly a lot of people are interested in doing comparison and taking finance leases or operating leases out of ITHR or out of PP&E, and so they can get a apples to apples comparison. So this rule is helping to support that. So if you see this rule, that's the reason for it. If we go to the next slide, please. All right, so we're going to go. The next rule, DQC rule set 15. This is just a review of the rules that are that have finished public review, and they were approved by the DQC committee on June 29th, and they are expected, and we're expecting them to go effective on September 1st, 2021. Those rules. We've had a couple of late comments come in on those, so we've had a couple of changes to DQC rule set 15, and we'll talk about those in a minute for those of you who've run into that problem. So the first rule we've got here is fact value consistency over time, and this rule applies to both the IFRS and the US GAAP taxonomies. And what this rule does is it goes and it looks at items that are expected to be cumulative over periods of time, and then actually make sure that and it'll flag if the value for a shorter period of time is greater than a value for a longer period of time. So for example, you got revenues for the first quarter of $1 million. You don't expect revenues for the entire year to be less than $1 million. How did you get negative revenues in the next 3 periods? Now, there are some exceptions to this, and this is one of the issues that was brought up. In some cases, there are people can do reclassifications or adjustments. So basically, it uses the same rules that are used for the DQC 15, which is the non-negs. So an item in some cases can be negative and can reverse out of those accounts. So the rule now has been updated to take that into account. So we had a few comments from people for things like reclasses, for restatements or adjustments. So if you've used one of those axes on one of these values, the rule's not going to fire anymore. So that should pick up basically all of those issues. So if you've seen these rules, if you've seen this rule and you've had that case, I know some of you have, that's now been corrected. So if you're going to run the rules again, you're not going to see that issue come up. Okay, if we go to the next slide, please. All right, so the next rule relates to concentration risk. So there are a number of, there's one line item that is in the US GAAP taxonomy for concentration risk percentage. However, that value can be dimensionalized many ways depending on what type of risk you have and what the base measure is for it. So this rule basically is checking that those have been used appropriately. So this will, this rule requires that the multiple dimensions are used. The way that this is modeled in the taxonomy is quite quirky. It's quite difficult for people to get correct. So this rule is just helping filers make sure that they've just entered this data correctly. The next rule, this is a text block rule related to the schedule, the reporting of acquired finite life intangible assets. This element is expected to be used. There's an element that should be used with the business acquisition axes and one that shouldn't. So this rule just makes sure that you've used the right text block. The next item is missing business acquisition axes. So basically in the rule 15, version 15 of the rules is going through and it's looking at, there's a number of rules focused on business acquisitions. And if you have a business acquisition, there's an expectation that you use the business acquisition axes. So this rule is just looking for facts which basically indicate that you've got a business acquisition, and basically is going to flag we haven't used that business acquisition axes. There are a number of cases where companies haven't used it, so this rule is picking that up. So basically the resolution for these is to put the fact value on the business acquisition axes with a member that indicates what the business acquisition was. So we can go to the next slide, please, Michelle. The next rule is line items requiring the asset acquisition axes. In 2021, the FASB added the asset acquisition axes, and the reason to do that was to distinguish between business acquisitions and asset acquisitions. There's a difference between the two of them. So what had been happening in the past was folks have been putting within an asset acquisition, they'd be using the business acquisition axes. So this rule basically identifies the new asset acquisition elements that were added, and then just make sure that no one goes and uses those elements in the business acquisition axes. And we've had a few errors with this already that we saw on some of the first 2021 filings that came out. So hopefully this rule should help clean that up and make sure people don't make that mistake in the first place. The next rule, kind of similar, is line items requiring the business acquisition axes. So this is typically information about a business acquisition, but you need the business acquisition axes associated with it, so you know which acquisition you're talking about. So this might be things like description of the business acquisition, or the start date of the business, or the date of the business acquisition. So you need that business acquisition axes there. So this rule is just checking if those line items are used and the values reported for them, that the business acquisition, the business acquisition axes has actually been used. Okay, so we go to the next slide. Did we miss one there?
No, Campbell, I think that's the last of the, let me just check through. Oh, I'm sorry, we did.
Okay, I thought there were a few more.
Yeah, sorry about that.
Okay, yeah, you want me to finish. Okay, so gross acquisition, this is just a calculate, this rule just checks the calculation between gross acquisition and then less than net acquisition. This is basically looking at, just make sure that the correct elements are used, and it's just looking at the gross payments and the net payments and making sure that the payments to acquire a business gross is consistent with the amount net, and that the reason that we saw some errors here, payments to acquire the business net of cash acquired, that element was being used inappropriately because it was including the gross amount. But so doing this, if you've got all three components there, this rule just checks that those elements are getting used appropriately. And the final rule here, assets acquired net of goodwill. It's another calculation item. It's just the amount that the values reported net of goodwill and gross of goodwill are being used appropriately. And some filers were getting those two elements mixed up as well. So this rule is trying to just make sure that they are reported correctly. So as you can see, DQC rule set 15 is really focused on the business acquisition axes, and to some extent on the asset acquisition axes if you're doing asset acquisition. So just be aware of that, the distinction between those two. There's two different axes that need to be used if you need to make those disclosures. And then there are a number of rules added around concentration risk to make sure that's correct. So you may see, and this is probably the most common, and you probably see concentration risk type errors coming up from DQC 15. If you don't have any business acquisitions. And then V16, really the focus on that is really to try and get the face financial statements as clean as possible, and also to address the issues with transition elements. So if we can go to the next slide.
Yeah, well, before we move on to CPE questions, I have a few questions that have come in for you.
Sure.
Okay, the first, this really relates to the relationship with the FASB and the DQC RT that Shelley mentioned early on. How does the FASB decide which rules they want to include? What kind of process do they go through?
So they've done a review of what the process is, the process we have to review and validate rules. So they've looked at that. And then in terms of choosing the rules, they basically look at rules that have been in effect for a prolonged period, so that they know those rules are working correctly before they will push those into the taxonomy. So we're kind of like going through and making sure the rules are tested and they're robust, and any issues have been ironed out. So typically the rule is going to have been in effect for probably a year before they're going to pick that rule up. So that's good, so that we don't have situations where people get SEC warnings when they're not actually legitimate warnings. We want to avoid that at all costs. And then secondly, they've tried to look at those rules which have a high number of errors so that we can get those issues addressed and bring them to people's attention if they weren't aware that they were having these issues. So it's kind of, you know, when they file to the SEC, they're going to see these issues. They're going to become pretty apparent to them.
Great. I have a couple of other questions. And I also just want to remind the audience that if you have your own questions, you know, you can click on the Q&A link and submit a question there for Shelley or for Campbell. So the next question that I received is, does the FASB only include rules for US GAAP filers, or do they also include rules for IFRS filers?
All right, yeah. So they only include rules for FASB filers, for US GAAP filers, sorry. So those are the rules that they're picking up. Now, so there are overlap between them. There are a number of rules that will also apply to IFRS filings. So, and the way that the SEC will implement some of those will mean that for IFRS filers, they're going to get picked up anyway. So typically there's a couple there, like if you flipped a calculation, you had that the wrong way around, that'll get picked up by both. But generally any rules that are going to be, you know, FASB specific they're only looking at the FASB rules, and it's coincidental if they happen to work on IFRS filings as well.
Okay, I've got a couple more questions here, actually. Do you expect the FASB to increase the pace of incorporating rules? Right now, I think Shelley had indicated there are 6 rules. Do you expect that to increase beyond 3 next year, or will they maintain the same pace?
Yeah, I think they're going to maintain the same pace. So for 2022, they're going to add another 4 or 5 rules to 20022 as well. So they basically are doing 4 or 5 rules for each release of the taxonomy.
Okay, and then the last question I have is, when error messages come from the SEC's EDGAR system, are they the same messages that a filer would get if they were using the DQC rules? Are they basically the same messages or different messages?
They're the same message.
Okay, so if you use DQC rules, then essentially you're covered for whatever the SEC may be checking in addition.
There are obviously SEC has additional rules like the EDGAR filer manual rules. So the DQC is not covering those because the SEC is already covering them. There are some rules which are that they haven't adopted because they have an equivalent rule. So for example, we have a rule that checks for deprecated items. The SEC has an equivalent rule. If you use an item that's been deprecated, they check for that. However, their rule is a little more, it's a little bit different in that it also checks if you do a filing and you have, let's say in the 2020 taxonomy, and an element you're using in 2020 was deprecated in 2021, or is scheduled to be deprecated as part of 2021, it's also going to give you a warning for that. So, but in the 2020 taxonomy itself, it hasn't been deprecated. It will still give you that warning. The DQC rules will not give you a warning for that because we don't, we think it's appropriate that you use it. But the SEC is looking at that, and they potentially might change that rule and give you an info fact about it rather than a warning, because technically it's still allowed, but they just want to make sure that people are aware that this element is going to be deprecated. So you need to think about changing it.
Okay, and when the SEC issues a warning, that's triggered by a DQC rule, does the filing still get accepted into the EDGAR system?
Yes.
Okay. All right. Okay, and then just one last question. Do most XBRL provider or preparation tools already have EDGAR filer manual checking in them? So that's already handled by the vendor.
Yeah, most vendors will support EDGAR filer manual checking, so that they, especially for those ones that are errors, because then the filing won't be able to be submitted. But then many of the vendors who you saw listed will incorporate the DQC checks into their software as well, so that you can at least the DQC checks can be run. And all the ones that the SEC have adopted can be run by, the version that everyone's up to will support all those.
Okay, great. Those are all the questions that I have. So I think we'll go to CPE questions now. So we're going to go to our poll number 3. Okay, so hopefully you can see this on your screen now. Which of the following rules have not yet been approved by the DQC? Is it number 1, fact value consistency over time? Number 2, fact value consistency over time IFRS. Number 2, fact value consistency over time US GAAP. Number 3, incorrect transition elements used. Or number 4, negative values. So make sure you click on the appropriate link. And we'll take like another 20 seconds here for this question. Okay, great. We're going to close down the polling on that. And the correct answer to this one, the rule that has not yet been approved, is incorrect transition elements used, which is the one that Campbell was explaining just a little bit ago. So now our final CPE question, what does the proposed rule incorrect transition elements used seek to resolve? Is it cases where the company reports line items that have been transitioned because of changes in accounting standards? Or is it cases where the company reports line items that are no longer available in the latest release of the US GAAP taxonomy? Or is it cases where the company reports line items that have been replaced by new elements that the company should use? Which of those 3 answers is most appropriate? Okay, just like another 15 or 20 seconds here. Okay, we're going to close down the polling. And the correct answer was actually number 1, cases where the company reports line items that have been transitioned because of changes in accounting standards. So thank you very much for responding to those polls. And I want to thank Shelley Waveren very much for participating in the webinar today, and also even more importantly for chairing the Data Quality Committee. Thank you to Campbell Pride, our President and CEO, for his remarks on DQC 15 and 16. And I want to invite all of our attendees to some upcoming webinars we have. August is a big month for us because there's a lot going on. Next week, we have an XBRL API webinar that's going to take place on August 11th. And that will be particularly interesting, I think, to filers because you'll be able to use our API and a simple Excel spreadsheet to run the rules against your own filing. So we're going to show you some new features to the Excel template that we have that leverages the XBRL API, and including the ability to run your own filing against the rules. So that's next week on Wednesday. And then August 18th, we have a webinar on mutual funds and inline XBRL. This event is taking place because small mutual funds are required to begin complying with the new inline XBRL requirements starting this September. So please join us and get the basics of the rule, but you'll also get to hear an individual from the SEC's investment management group. Jacob Sandoval is going to be joining us. So he's going to share his insights into how the SEC is using mutual fund data and how they felt the rollout of wave 1 of mutual funds, which was large funds last summer, how that went. And then finally, on August 25th, we're going to be holding a webinar for FERC filers. So this is a little bit different. This is for those companies, public utilities, and others that have to comply with Federal Energy Regulatory Commission rules related to XBRL. Every public utility is going to begin filing starting at the end of this year in XBRL format. So please join us for these 3 events coming up in the next few weeks. And Feel free to forward these on to colleagues and clients to let them know about them as well. And we look forward to seeing you at our next webinar. Thank you very much.